Hello, everybody. Thank you for joining me today for the next episode. What is this? I'm Yevgen Pitelman, real estate agent with Coldwell Banker Real Estate. And today I'm going to ask all these questions to our preferred mortgage broker, Sal Tomaselli, with over 35 years of experience
Morning. Good
in the
morning,
mortgage
everyone.
field. Hi, Sal. How are you?
Good morning, Eugene. Very good. How about yourself?
Thank you. Thank you. I'm good. Thank you very much for taking the time to do that. So, look, lately, I'm experiencing influx of, we have a much more buyers coming to the market, and most of them first-time home buyers. And again and again, I hear the same question, and I would really love you to answer that. So it will be perfect and to a T. So the first question is, what's the difference between pre-qualification and pre-approval, and what's approximately the time frame, and would any of these affect the credit score, or if anything at all, those two procedures?
So to answer your question, a pre-approval is stronger than a pre-qualification. Pre-qualification is typically verbal statements made by a buyer, and they say, well, my income is $80,000 a year, my wife's $120,000 a year, and our credit's good. And so it has it's less there's less verification process.
And has less value, probably, right?
Yeah, because they're relying on just verbal statements, and a lot of times lenders or banks will issue a pre-qualification very easily. However, we don't do that at Professional Mortgage. What I generally do is we do actually a full-blown pre-approval. So when typically what'll happen is let's say you have a client, you refer them over to us. We'll have a conversation. We'll do a deep dive with the client, and we'll ask them a lot of questions, regarding their assets, their income, how long they've been working. And then we ask them to send, my standard email is to get, to ask them for documentation to back that up. Generally, it takes, it's either same day or within 24 hours, depending upon when we get the information. And then we'll issue an actual pre-approval. And a lot of times we'll run that through an automated underwriting system. So that's either through Fannie Mae or Freddie Mac. So we'll take that client's information, and it's there. They take into consideration the income, the assets, how much is in savings, the credit, and the type of property that's being purchased. And we'll typically get back an approval from that, which is through the automated underwriting system. And that really holds a lot of weight. And that's something that I urge people to do, because it takes the guesswork out of getting approved. Once we've done that, really the only thing that's left really is the appraisal of the property, to make sure that the property meets standards and is being purchased at the right price. Mm-hmm. And the title report. So it takes a lot of the unknowns, on the buyer side out of the picture, mm-hmm. And it solves a lot of those problems in advance. So as a realtor, you probably want to see, I know you want to see, because I work with you, so yeah. You want to see a pre-approval, you want to run right. Through an automated underwriting system. So there is a difference. There's a lot of nuances to that, but there is a difference between a pre-qual, which right. Holds less weight, and a pre-approval, which is really verified information. So
right. And then as far as if you do the pre-approval letter, does that involve checking the credit? Does that involve can that affect the credit score of these people? Because
yeah. It's a great question. It comes up all the time. The bureaus, there's three major credit bureaus, and when you run someone's credit, if you run it, so they look at there's modeling, right? That's built into the credit system. So if you're a buyer shopping for a mortgage and you go to three different banks, there's generally not a lot of harm if each lender pulls that credit. Okay, a lot of times we do something called a soft pull, which basically doesn't really register as a full credit pull. But the systems, there's a scoring model, it's called the FICO, Fair Isaac scoring calculator, I believe it is. And it basically it understands that if you're shopping for a mortgage and you go to a couple of different mortgage companies and everybody has a certain code, then it's not going to affect your score. However, if you apply for a car lease and apply for a new credit card and apply for a furniture loan and apply, that will
That's a
affect
different
the
story.
score
Yeah.
because it's showing that you're about to spend a lot of money across various industries.
Okay.
So typically the short answer is no. Pulling your credit within
But
the same narrow industry will
for the
not really
purpose of
affect,
pre-approval letter,
right, will not affect your score.
will not affect. Okay. Okay, good.
What I do for clients is I, because I people are still a little apprehensive about pulling
Of course.
credit most of the times, and nobody really knows what their exact credit score is. It's changing all the time based on your spending level and payment history. So what I usually do is when I start working with a client, one of the first things I do is I provide them with a copy of their own credit report so that they can have it in a hard copy. So if they walk into a realtor such as yourself, they could say, "Hey, Eugene, here's my score. I have a 750 or a 780 score. I have very good credit here. Here's a copy of it that you could see." So a lot of times that alleviates, if you're working with a good mortgage company and a good realtor, there's no reason to pull that credit multiple times. You get a copy of it and then you use that. And they're usually good for, 30, definitely within 30 days, but, typically within 90 days,
I was going to ask, so 90 days, after 90 days, let's say, especially in today's market, and if you're picking, well, you cannot find, let's say you couldn't find the apartment to purchase, right? So 90 days, do I go, and then if you need to extend that pre-approval letter, what would that involve?
It's just a re-verification of data. So as long as you have the same job, same income, same asset position, generally, it's very easy to renew that.
So you don't have to run the numbers.
And you have to understand something. I think the high on the credit score is 900. Nobody has a 900 typically. But anything over a 720 is considered exemplary. So when sometimes people get very hung up on their credit scores and they're worried, if they drop below 800 or they drop below, banks really don't look past 720. Generally, if you're 720 or higher, you're fine because the score will change on a daily basis, on a monthly basis, just based on spending habits and payment histories. So, typically it's based on utilization of credit cards. So, if you have a $10,000 limit and you spend 2,000, well, that's okay. But if you're at 9,800, you're kind of close to the upper end of your limit, and that might drive your score down a little bit. Those are factors that'll address, that'll change credit scores.
I see. Okay, I got you. Thank you. Is there anything else you want to add to that? Any details as far as pre-approval process, timeline?
It's really important as a first-time home buyer, or as anyone who's looking to purchase real estate, is to get pre-approved or pre-approved first.
Right.
Start that process early, because it gives a lot of confidence to the realtors and all the other parties, the seller, the realtors. If somebody walks in with an offer that they've been pre-approved, and you have somebody that walks in with, that's just, we'll call it naked with no information. The seller is always going to gravitate towards the individual that has done the due diligence and has gotten pre-approved.
Right.
You know, a lot of times, you know, there's two realtors in a transaction. There's a listing realtor and a selling realtor sometimes. And, you know, I'll get a call from the listing realtor and say, hey, is this a good deal? Will this close? Do you see any impediments? Do you see any, you know, any things that can block this deal from closing? And I, you know, typically, you know, I answer very honestly, and I tell people, and sometimes realtors get hung up on, you know, well, they're not putting down 20%. Well, you know, you can get into properties with 1% down, 3.5% down.
Right.
If you qualify, you qualify, you know, and I wouldn't get too hung up on the amount of the down payment, because the process is essentially the same. You know, it typically takes, you know, 3 to 6 weeks, you know, for that pre-approval and, you know, getting a file clear to close. So generally, whether the person's putting down half or they're putting down, you know, only 3.5%, as long as they qualify, I wouldn't really get too hung up on that.
I got you. Okay. Thank you. That's definitely a great answer. That's what I was expected from you. So so thank you so much for clearing that. I'm gonna share this answer with all my home buyers, and I will get back to you with the next one next time.
Thanks, Eugene.
Thank
Pleasure
you.
working with you and your clients.
Thank you.
Take
Thank you
care.
for your time. Bye-bye.
All right. Thanks.
Bye-bye.
Bye-bye.